Hi everyone, welcome to my YouTube channel. My name is Tabitha, and if you're new to this channel, welcome. And if you haven't subscribed yet, please subscribe. And today we're going to talk about liabilities. And the reason why I'm introducing this topic to you is because in life, and sometimes there's time we have to take liabilities because of our unlimited want and limited resources. So some liabilities to the bill as well, and we cannot avoid them. So we just have to take liabilities. But why is it important for you to know is because you pay cost of borrowing. So the cost of borrowing, which is interest, and later on in my next video I will be talking about simple and compound interest and why is it important for you to know the difference. So if you know you're borrowing, is it good for you to pay simple interest or is it good for you to pay compound interest? And before we get there, we have to know what are these liabilities and the type of liabilities that we have. So liabilities we already defined in this channel, that is an obligation that you have to pay. It could be within a year or beyond 2 years or 3 years. So it depends with the person that you agree with. There are different types of liabilities. Known and definite. So the one that is known, you are certain about the amount of you owed, and you also certain about the time that you were supposed to pay. So certain about the amount of money you owe and then when it's supposed to be paid. And these are type like account payable, uncertain revenue, and revenue. Account payable, for example, is when a company buys goods on account and promise the supplier that they will pay on the 30th. So they know that by the end of the month they are supposed to pay that amount. Did they get a good of 500? Then they know 500 is due by June 30th. Another type of liabilities is estimated. So in this, you know that you're supposed to pay this liability, but the amount of that you're supposed to pay is uncertain. Some people sometimes they go to tax personnel and they are surprised that they are supposed to pay more tax. So if they weren't aware that this amount they did not pay, or the estimated amount that the company that they work for deduct from their paycheck was not the amount that the government wants. So this estimated amount is uncertain, but you know the time that you're supposed to pay that liability. For example, we have warranty payable and we have also income tax payable. Another one is contingent, a potential obligation that depends on the future event and it may or may not become a real liability. This thing is things like lawsuits, environmental damage. Maybe your company is protecting themselves from lawsuits, so that's a liability, right? And then the environmental damage, maybe your company did something wrong and they have to pay, so that is also a liability. This thing might not happen or might, it depends. So we have notes. So all these type of liabilities can be divided now into current or long-term liabilities. Depend, like account payable is a current liabilities, and hand revenue is a current liabilities, things that happen within that year. Maybe a loan, bank loan is a current liabilities. Student loan could be long-term liability depending on you. Note payable is a long-term liability to mortgage can be a long-term liability. So all those type of liabilities, they goes into current and long-term liabilities. This is the end of the video, and if you haven't subscribed yet, please subscribe and look forward into seeing my next video, which will be on simple and compound interest, and we will discuss why is it important for you to know which one is the best when borrowing money. Thank you and bye.